The market is falling 35%. James is staring at his portfolio, watching hundreds of thousands of dollars disappear. Nick is looking at the exact same market crash. But Nick isn't panicking. He's checking how much cash he has available to invest. They both saw the same warning signs. They both knew a downturn was possible. They both had money in the market, so why is one of them terrified while the other is preparing to buy? The answer isn't that Nick predicted the crash. He didn't. He simply prepared differently before the crash arrived, and some of the things he did had almost nothing to do with picking stocks. Before we get into exactly what Nick did differently, subscribe to Mike Money, because this isn't about predicting the next crash. It's about understanding what financially prepared people do before everyone else realizes there's a problem. And by the end, you'll see exactly how James could lose money even if he correctly predicted the downturn. Meet James and Nick. Both are 42. Both earn six-figure incomes. Both have built investment portfolios worth around $500,000. They live in the same city, have similar lifestyles, and have watched markets rise for years. But they prepare for uncertainty in completely different ways. James believes his biggest job as an investor is choosing the right assets. Nick believes his biggest job is making sure he never has to make a desperate decision. That difference doesn't matter much when markets are rising. It matters enormously when they fall. Start with James. His $500,000 portfolio is mostly invested in stocks. He has about $12,000 in cash. His mortgage is large, his monthly expenses are high, and his emergency fund would not cover a long interruption in income. On paper, James looks wealthy, but a large percentage of his financial life depends on markets behaving well. Nick has roughly the same portfolio, but his financial structure is different. He keeps a larger cash reserve. His debt is manageable. His monthly expenses are controlled. He knows which money he might need in the next few years, and that money is not sitting entirely in volatile investments. This is the first lesson. Preparing for a downturn is often less about predicting the market and more about reducing the number of situations where the market can control you. Nick cannot control stock prices, but he can control his liquidity. He can control his debt. He can control his spending. He can control how concentrated his investments are. He can decide which money is truly long-term. Those decisions create something more valuable than a prediction. They create options. Now imagine the downturn begins. The market falls 10%. James tells himself it is temporary. Nick does the same. Then the market falls another 15%. James's $500,000 portfolio is now worth roughly $375,000. He's down about $125,000. The number hurts. But the bigger problem is what happens outside the portfolio. James's company announces layoffs. He keeps his job, but his confidence disappears. Now his investments are falling at the same time his income suddenly feels less secure. He starts watching financial television. He searches for recession forecasts. He reads predictions about how much lower the market could go. Everyone has an answer. Nobody has certainty. James discovers something uncomfortable. He doesn't actually know what happens next, and neither does anyone else. Nick sees the same uncertainty, but he prepared for it while he was calm. Months earlier, he had increased his emergency reserve. He paid down some expensive debt. He cut a few unnecessary monthly expenses. He made sure the money needed for short-term obligations wasn't dependent on stock prices. He did not do those things because he knew a crash was coming. He did them because crashes are always possible. That distinction matters. You don't need to predict a storm to carry an umbrella. And you don't need to predict a market crash to reduce the chance that it can wreck your finances. Now the market falls again, down 30%. James sees $150,000 of his portfolio disappear from the peak. His first instinct is to sell. He tells himself he will buy back later, when things feel safer. This sounds rational. It is often disastrous, because James has forgotten one of the hardest truths in investing. You have to be right twice. You have to know when to leave. Then you have to know when to come back. The problem is that fear rarely tells you when the second moment has arrived. Nick experiences the same decline. He doesn't enjoy it. He doesn't pretend losses don't hurt, But he doesn't need the money next month. His emergency savings cover his essential expenses. His income still covers the mortgage. His investments were built for a long time horizon, so the market can fall without forcing him to become a seller. That changes the psychology completely. James sees a falling market and thinks, what if it gets worse? Nick sees the same market and asks, what did I already decide I wanted to own for the next 20 years? That question leads to another important habit. Before the downturn, Nick created a watch list of investments he would be comfortable owning for the long term. He focused on diversified funds and durable businesses rather than whatever had been trending. He knew why he owned them, he knew what could go wrong, and he knew what price would make him more interested. This doesn't mean he knew the bottom. He didn't. Nobody does. Instead, he had a process. Maybe he invests a portion of available cash after a major decline. Maybe he continues normal monthly contributions. Maybe he rebalances back toward his target allocation. The exact method can differ. The principle is the same. He makes decisions according to a plan instead of according to headlines. This is one of the quiet differences between experienced investors and emotional investors. Experienced investors still feel fear. They simply try not to let fear make the decision. Now imagine James sells after the market has already fallen 30%. He waits for the situation to become clearer. 3 months later, the market rebounds 12%. James waits. Then it rises another 8%. Now he feels trapped. He knows he needs to get back in, but prices are higher than when he sold, so he waits for another crash. It never comes. Eventually he buys back at a higher level. James correctly recognized that markets were dangerous. He still lost money because he acted without a complete plan. This is why preparation before a downturn matters more than confidence during one. Your future self is going to have emotions. The best way to help that version of you is to make the important decisions while you are calm. Now let's talk about liquidity. People sometimes look at cash as wasted opportunity. During rising markets, a large cash reserve can feel inefficient. But cash does something investments cannot always do. It can wait. If your emergency fund is invested in stocks and the market falls 40%, your emergency fund has suddenly become less useful. If your emergency fund stays in a safer, liquid place, it can still do its job. This isn't about trying to maximize every dollar. It is about matching the tool to the job. Money needed soon needs stability. Money needed decades from now can usually tolerate more volatility. That distinction can prevent forced selling. And forced selling is where many investors get hurt. Imagine James needs $30,000 for a major home repair during the crash. His portfolio is down 35%. He has only $8,000 in cash. He now has to choose between expensive debt and selling investments at depressed prices. Nick has the same repair, but he has a dedicated reserve. He fixes the house. The market can remain down. His investment plan doesn't have to change. That is the value of preparation. It doesn't necessarily make you richer immediately. It makes you harder to break. Now look at concentration. James owns 5 different stocks. He thinks he is diversified. But 4 of those companies are in the same industry. His employer is also in that industry. His salary depends on it. His retirement portfolio depends on it. If the industry gets hit, several parts of his financial life can suffer simultaneously. Nick looks at risk differently. He asks, if this one company, industry, or region has a terrible year, how much of my life is affected? That question exposes hidden concentration. A portfolio can contain many assets while still depending heavily on one outcome. Diversification isn't exciting when one sector is dominating the market. It becomes valuable when that sector stops dominating. The same principle applies to debt. During good markets, leverage can look brilliant. Borrow money, buy assets, watch prices rise. But debt creates obligations that do not care what the market is doing. Interest still needs to be paid, mortgages still need to be paid, businesses still need cash. If assets fall while obligations stay fixed, flexibility disappears. So Nick isn't obsessed with having zero debt. He is focused on avoiding debt that could force him to sell during a bad market. That's a deeper idea. The goal isn't to remove every form of risk. The goal is to remove risks that can become fatal. Now the downturn gets worse. The market falls 40%. Headlines become terrifying. People who were confident 6 months earlier start saying the financial system is broken. James is almost out of cash. Nick still has reserves. And suddenly, the same crash looks different to each person. To James, it is a threat. To Nick, it is uncertainty. That does not mean Nick knows what will happen next. It means he has enough financial space to wait, and waiting is a form of power. When you don't need to sell, you can choose. When you don't need to borrow, you can negotiate. When you don't need the market to recover next month, you can think long term. This is why wealthy investors often value optionality. Cash provides options. Low fixed expenses provide options. Manageable debt provides options. Diversification provides options. A long time horizon provides options. Options are easy to ignore when everything is going well. During a crisis, they become extremely valuable. There is one more reason they prepare this way. They know a downturn can create opportunities, but only for people who have capital available. Imagine a quality business falls from $100 to $65 because investors panic. That does not automatically make it cheap, and Nick will not buy simply because the price dropped. But if the company still has strong finances, durable demand, and a business model he understands, the lower price may improve the potential return. This is why wealthy investors often build watchlists before markets fall. They research when everything is calm, so they don't have to research from scratch while everyone else is panicking. They know what they want to own, what risks could invalidate the thesis, and roughly what valuation would make the opportunity attractive. They also understand taxes and transaction costs. Moving in and out of investments repeatedly can create unnecessary taxes, fees, and mistakes. A long-term strategy can be more powerful because it allows an investor to stay focused on the underlying asset instead of reacting to every price movement. That is the broader pattern. Prepare early, act selectively, and keep enough flexibility to change your mind without destroying your plan. And notice what is missing from this approach. There is no magical indicator, no perfect forecast, no secret stock list, no guarantee. It is simply preparation. The wealthy cannot remove uncertainty, so they build financial lives that can absorb it. That is why their most important decisions are often made before the downturn becomes obvious. That is the part most investors underestimate. There is another misconception worth breaking. Being wealthy does not make downturns emotionally easy. A person with $20,000 invested can lose $6,000 in a 30% decline. A person with $2 million invested can lose $600,000. Both losses hurt. Experience doesn't remove fear. It teaches you what fear is allowed to change. Nick can feel anxious and still keep his long-term plan. That is not because he is fearless. It is because he decided what mattered before the market gave him a reason to panic. This is why systems matter. Automatic contributions, diversified holdings, separate emergency savings, clear spending targets, rebalancing rules, defined time horizons. The more you decide in advance, the fewer decisions you have to make while your emotions are loud. Now imagine the market finally reaches what turns out to be the bottom. Nobody knows it is the bottom. That's the point. The headlines still feel terrible. The economy still feels uncertain. The recovery isn't obvious. James is waiting for confirmation. Nick doesn't need confirmation. He isn't trying to call the exact low. He is simply following the plan he created when prices were higher. He invests gradually. He keeps contributing. He buys assets he already researched. Then something changes. Months later, the market begins recovering. People who waited for certainty start coming back. James returns too, but he returns after prices have already recovered substantially. Nick didn't win because he predicted the bottom. He simply avoided making the bottom worse for himself. That is a much more realistic definition of investing skill. Now go back to the moment before the crash. The market was still rising. James thought being invested was enough. Nick thought being prepared was part of being invested. That's the difference. Before the next downturn, don't start by asking which stock you should sell. Start with the questions wealthy investors ask about their entire financial system. How much cash do I need for emergencies? How much debt creates pressure? How much of my income depends on one company or industry? How much of my portfolio is concentrated? Which money will I need within 1, 3, or 5 years? Could I keep paying my essential bills if the market stayed down for a year? Would I be forced to sell? If the answer is yes, the problem may not be the market. It may be your structure. And the solution is not always buying something different. Sometimes the solution is creating more room. More cash, less unnecessary debt, lower fixed expenses, better diversification, a clearer plan. That is how you turn a market downturn from a personal emergency into a temporary investment problem. And there is one final lesson from James and Nick. The wealthy are not necessarily the people who see the downturn first. They are often the people who can afford to be wrong about the timing. They don't need to know whether the crash starts next Tuesday or 2 years from now. Their financial structure works in both scenarios. If markets keep rising, they participate. If markets fall, they can wait. If opportunities appear, they have capital. If life gets difficult, they have liquidity. They don't require one prediction to come true. That is resilience. And resilience is one of the most underrated forms of wealth. James eventually understands this. He used to think Nick was better at investing because Nick always seemed calm. But Nick wasn't calm because he knew the future. He was calm because he had reduced his dependence on knowing the future. That's a completely different skill. James was trying to predict the storm. Nick was trying to build a financial life that could withstand it. And maybe that is the lesson you should carry into the next market downturn. Don't ask only what will the market do. Ask, what happens to me if I'm wrong? If the answer is that you panic, borrow, or sell, your preparation isn't finished. If the answer is that you can keep living, keep investing, and wait, you've built something much more valuable than a market prediction. You've built resilience. Markets will fall again. There will be another scary headline, another recession, another reason for people to believe everything is different. And when that moment comes, you won't need to know exactly what happens next. You will need enough liquidity to wait, enough diversification to survive, enough discipline to follow your plan, and enough patience to let time do its work. The wealthy don't necessarily survive downturns because they saw them coming. They survive because they prepared while everyone else was still comfortable. And sometimes, that is the closest thing investing has to a secret. If this changed the way you think about market downturns, subscribe to Adrian Money, because the next financial lesson you learn could be the one that saves you from making an expensive mistake when the market turns again. And remember, you don't need to predict the storm. You need to make sure you're still standing when it passes.